Okay, everyone, today I'm really excited to have Mike Heroux, who is founder of Dividend Stocks Rock, on the show. So, a little bit of background, Mike, before we dive into the questions, but I have been following you for a long, long time and really enjoying your content. So, I started my investing journey back in 2018, and I believe it was 2020 when I stumbled across your blog, the Dividend Guy blog. And the way you wrote about investing and the way you taught all the important points, it really resonated with me. So first, I actually want to thank you for having a really positive impact on my life. And I was actually mentioning to a friend yesterday that I was interviewing you, and they got excited as well because they said that you positively impacted them as well. So just a
Wow,
bit, because you sometimes
that's
you
a
don't
lot
know
on a
that.
Friday morning.
Yeah, no worries, no worries. Because sometimes you have no idea the people you are impacting on the other side. So I wanted to let you know, which is why I'm so excited to have you on the show. So welcome.
Well, thank you so much for the introduction. Actually, it's kind of ironic because one of the main reason why I quit my job as a private banker and started this journey online was exactly the fact that as a private banker, I was able to help like a few hundred clients. I had like a 300 clients in my book, and that was pretty much it. I mean, there's like a limit of time that you can allocate to clients at one point. And now I have this chance to do what I love. And on top of that, reach out to thousands of investors instead of a few hundred. So I'm blessed. I'm super happy and humbled by all of this. So anyways, thank you for having me. It's going to be a nice show, I think.
I think so. Let's dive right into it, Mike. So I would love to know, how did you settle on dividend growth investing as your approach?
Kind of funny because at first, as a lot of investors probably, I just started because I enjoyed investing. So I got my first job right after doing my bachelor degree, and 2 weeks later, I go to the bank branch and I said, "Oh, I'm gonna get married. I need a line of credit of $20,000." So, I mean, half of it was true. I didn't need the line of credit for that. I was getting married though, and then I told my girlfriend to become my wife. Yeah, don't worry, Jose. We're just gonna take like $3,000 out of that line of credit. We're gonna start investing, but it's just like $3,000. It's nothing. And after the end of the month, I was at $19,000, 500, already leveraged, buying and selling stocks all the time, having so much fun, and I just grew that passion for the stock market at this point. It was back in 2003, so a monkey would have made money. So of course I thought, well, I'm a genius, right? After a few years, I was doing very well. I built my first cash down like this, bought my first house, everything was fine. But it was first very demanding, and of course as the market evolved, I eventually thought I was invincible, made a bunch of bad trades, lost money. And while I was building my career, I had also a side business online that started back then, and I had kids. So then I started to lack of time. I could not spend 3-4 hours a day on the stock market plus living the rest of my life.
Hmm.
Back then, with my side gig, I was flipping blogs. So I realized in the early 2000s that we were able to buy personal finance blogs, improve them, and then selling back them, or just like making money advertising. So I was like buying and selling small blogs. And eventually I was reading the Dividend Guy blog back then. Found it very interesting. His approach is focused on dividend growers and stuff. And then I noticed at one point that the author slowed down his pace on writing. So I was like, oh, that's probably a good timing. Because, I mean, creating content all the time, you know that with the podcast, it's tiring at one point. So I offered him to buy the blog in 2010. And this is how I got really started at the same time, thinking, well, now I need a real strategy. The fun is kind of like over. I'm soon to be in my 30s. I need an investment plan. And I was a financial planner back then, and I was like, dude, I'm not even doing the thing that I'm telling my clients they should be doing. So in 2010, when I bought the Dividend Guy blog, I really transformed my entire portfolio into a 100% dividend growth oriented portfolio. And that was the beginning of that journey into dividend growth investing. That is now 15 years and counting. I have slightly changed, like made a few tweaks in my approach over time, but not that much. And that is part of the success of any investors, not just focusing on dividend growth investing, but rather focusing on the same strategy and sticking it to it for so long. And yeah, I what I realize is now I don't know, I need maybe like 2 hours every quarter to look at my portfolio.
Wow, really? Okay.
We're going to dive into it pretty sure like later on, but I've built tools to help me out doing that. So about a couple of hours every quarter, and then I do a big review at the end of the year. But what I love there is during the rest of the year, I don't even have to think about my investments. So it's almost passive, like a little bit more work than doing ETFs, of course. But I have full control. I know everything that is in my portfolio. I know why a stock is going up or going down, and I can react to that as well. So the feeling of having my two hands on the wheel and being in control at all time, that's the number one reason I decided to go with picking stocks instead of going fully passive with ETF, which is, again, a strategy that works totally as well.
Okay, maybe go over the dividend triangle. This approach, when I first learned about it from you, it resonated with me because it was simple. I think it can save people some time and also end up with some good results. But go over this approach.
So I'm a big fan of the Pareto principle. So 20% of your effort, your energy, anything, 20% of what you're doing is going to generate 80% of your results. So the dividend triangle is following this principle where I use three metrics, so the three sides of a triangle, to determine if a company is worth more time for me to do the research and eventually maybe buying it. And usually I do all my buys and my sells based on that triangle. So the first component is, as an investor, regardless if you're looking at dividend investing or not, as an investor, what you want is a company that is growing, right? Like the whole purpose of a business is to grow their sales. So the first part is to look at the revenue trend. The 3 years, the 5 years, or the 10 years annualized growth rate is interesting, but I prefer to look at a graph so then I can identify what's going on during a recession, if it's cyclical or not. So it tells me a lot of information just about how the company grows the business. The second step is once I found a business that increased their sales almost every year, well, I don't want this company to burn cash all the time, so I want that company to also be profitable. So the second segment is the earnings per share. I could use cash flow, but the problem with cash flow is it could be quite hectic from one year to another. So it's less stable because if the company has specific projects, they will use that cash flow, which totally makes sense, but then the free cash flow is going to go down. So I prefer to use earnings per share. And over a long period of time, yes, on 1 year versus another, we could argue that you can play around with accounting rules a little bit and then sometimes put that into your advantage. But over 5 years and 10 years, it's pretty hard to play around those rules. Because I mean, if you play too much, it goes into fraud. So that's not going to happen. So once I have those two sides of the triangle, I have found a business that grows their sales and grows their profit, well, the next natural step is to reward shareholders with increasing their dividend payment. So a lot of people even say, well, Mike, you're not really the dividend guy because if you look at my yield, I'm usually between 1.75 to 2%. So it's pretty low in terms of yield, but my focus is on the increase. Because the increase is a vote of confidence from management. It's also the way for me to know, oh, if the business is confident enough in its future, because I mean, from the business point of view, the dividend is just another debt that they're paying. They're not getting anything out of that. It's not an investment. They're just giving back money to shareholders. But if they're able to increase it by like 5, 6, 7% year after year, well, they gotta tell me, we know that we're going to continue to increase our sales, increase our profit, and therefore we increase our dividend. And once you have those three metrics that are pointing towards the right trend, well, then you can do more digging, of course, but you're going to realize that most of the time, using the 20-80% principle, well, the company will generate good cash flow, they will have good margin, pricing power, they will have a robust balance sheet, all of those other metrics that are super important, like low payout ratios, they will all come because there will be a consequence of having a business increasing their sales, increasing their profit, and increasing their dividend.
I think that's a really important point because some of us gravitate to yield, But Mike, your approach focuses more on the consistency of that dividend growth, right? And we're going to get into yield a little bit later on. Now, I like that triangle. The first part of that you described as revenue. Mike, my oldest son is 11 years old, and I've gotten into the habit of sometimes showing him some charts, and I will show him the revenue charts first. And I'll ask him, is this a company worth investing in? And he'll kind of look at it. He's like, well, yeah, it's going up in a straight line. Maybe you could look into it versus if it's all over the map. So I love that approach. But now, so you use this tool to screen, decide what companies are perhaps worth researching a little bit further. And then what is your approach after that? Like, how do you kind of allocate your capital amongst the different sectors? How many stocks will you include in your portfolio? Can you talk a bit about that?
Yeah, I believe it's really important to have clear investing rules regarding all of this, your allocation, the number of stocks and everything. But those rules, I mean, I'm going to share mine, but they don't have to be yours in a sense where what is really important about those rules is to be clear so then you can take action rapidly. Instead of saying, oh, well, I'm a bit of a diversified everywhere. I have sometimes 20 stocks, sometimes 50. That doesn't really matter. Well, then you don't have a clear guidelines, right? So on my side, what I do first, I'm 100% invested at all times. So never have cash. If I have cash, I have like $1,000 of just accumulated dividend that I'm going to use to rebalance my portfolio, but rarely have more than $1,000 in cash. 100% dividend. 100% invested, and then I go with sectors first that I understand a little bit more. So I have like a background in finance and in technology. So most of the time, if you look at my portfolio allocation, I will have that 20%, which is roughly my limit to a sector. The reason why I put a limit is to make sure that I don't get overexposed to a specific narrative. Because all investment crisis in the history always starts from one specific industry getting hit, and then there's a domino effect. So if I have like 50% of my portfolio invested in AI stocks, like semiconductors, for example, well, of course, if we run into an AI bubble and it bursts, well, my portfolio is going to have a big hit. So I want to be protected on this side, and I also want to catch most of the opportunities that I have. So this is why I put that limit at 20. Sometimes I will go over between 20 and 30% as long as I have stocks in different industries in the same sector. So a good example would be with the financial services. So sometimes I will have up to 25%, but among my stocks, I will have Canadian banks, I will have payment processor like Visa, I will have asset manager like Brookfield. So if there's a mortgage crisis in Canada, Visa and Brookfield won't care about that. They won't be affected by this. So this is why instead of having like 6 banks and being like 25% invested in just like the same business model and then getting hurt, I want to have that diversification. So in terms of sector, that's pretty much it. And then in terms of stocks, I think the ideal number is between 20 to 40, depending on how much time you have to follow your stocks. Under 20, the problem is if you're making mistakes, they have a huge impact on your portfolio. If you have like 12 stocks and you're wrong on 3 out of 12, I mean, your returns are completely dead, right? It's not going to work well. Above 40, the thing is you're going to create overlaps. So you're going to just buy the same business models over again. And the other thing is you won't be able to follow up like quarterly 75 stocks, and they won't even have an impact, because if you have a stock that is worth like 0.32% of your portfolio, if it doubles, you're not even going to feel it. If it crashes and burns, you're going to feel it either. So right now my personal target is closer to 30 to 35. That helps me to define what is my full position. So in an ideal world, I would like to have an equally weighted portfolio, roughly 3.5% in all of my stocks. But some goes up, some goes down for obvious reason. So I will let my winners run. But when I have to enter into position, or if I look at a stock that is at 1%, for example, then I'm going to ask myself, do I like this company enough to bring it back to 3%? So again, simple question. It's a yes or no. If it's a no, I sell. If it's a yes, well, I find capital to increase it to 3%. So that makes my life super easy to do just quick decisions, because you cannot be right 100% of the time. but you can do all your actions with 100% level of confidence, which is a lot more important.
Mike, I have a hard time following probably more than 12 to 15 companies. Even sometimes then I feel a bit stretched. You mentioned you maybe spend a few hours every quarter. Is that because you continue to update your investment thesis and you keep track of the various metrics for each company? I'm still trying to refine this. How do I, find time to follow all my companies, not get stressed out by it? Do you have any strategies there?
Yeah, because if you're doing this as an individual investor and you don't use any tools, it is very time consuming. And it would not be realistic to say, oh, I have like 30 stocks and I'm just going to spend 2 hours a quarter on it. That would not work. Mm-hmm. The reason I'm able to do that is because I've built a system using Dividend Stocks Rock, which is the system that I've created in 2013, where I do have a team of analysts looking through all the quarterly earnings for over 1,000 stocks. So every quarter what I do is I run the report and then I have the summary. It's like a half a page per stock. And I have a summary of like what went well and what did not go well, the CEO comment, the link to the press release, and of course the 3 metrics. So what happened with the revenue, what happened with the earnings, and what happened with the dividend. So reading that report will take me about 2 hours. And for a lot of companies, the investment thesis is not going to change from 1 month to another. I mean, Coca-Cola has been selling Coke for a few years now, and I'm pretty sure that I could bet my house that in the next 5 years, they're still going to continue to sell Coke. So having that report is actually going to tell me, oh, Coke is divesting a division, or they are buying something, they're making a big acquisition, or they're making important moves. So this is where it's going to draw my attention, and then I can read further, maybe for 1 or 2 companies out of like the 30 that I have. All the others, most of the time, is just business as usual. I mean, I've been known to be a big fan of National Bank. This was my first and last employer, actually. I worked there for 13 years. It's my second or third largest position in my portfolio. But I mean, National Bank is National Bank. From time to time, there will be like a big event. Like last year, they acquired Western Canadian banks. But besides that, I read the report. I'm like, okay, so revenue's up, earnings up, dividends up. Nothing special about the business segments are doing whatever they have to do. So I move on. But this is the key here is to have a system in place and also having some tools that will do the hard work of going through all those earnings for you.
So a lot of us will subscribe to the approach buy XEQT and chill. So XEQT, BlackRock ETF, a global portfolio of stocks. Mike, I would just love to maybe contrast what you've done. Maybe you can shed a little bit light, if you're willing, on your returns using the dividend growth investing approach. Because some people will ask, well, the market's returned a very healthy amount. Can I truly outpace the market? I'd love for you to shed some light on this.
Definitely. So starting in 2017, on my blog, the Dividend Guy blog, I report every month my pension plan. So at that time, what happened, like long story short, in 2016, I quit my job. I traveled in Central America with my wife and 3 kids in a small RV. So we went for a sabbatical year there. Best decision of my life. Worst financial decision, best decision of my life. And when I came back, I said, you know what? I'm not going back to the bank. I'm going to focus online on my business online, and there you go. So I got my pension plan. It's a Lira account. I got $108,000 towards the end. It's in September of 2017. I got the check. So I report this account because first, it's a real case study, and second, I cannot add capital. So it's like the Lira, I mean, it's a locked-in account. You cannot withdraw, you cannot add capital. So the returns are pure, which is great because then you can see exactly what happened. Because you cannot hide behind the fact that, oh, the portfolio is down 25K, but I put 12K in, so I don't look to have it lose too much money, right? So that pension account annualized growth rate return is close to 14.5% since 2017. So I'm up about 200% right now as of December of 2025. Unfortunately, XEQT doesn't exist. It was created a little bit after that, so I cannot completely compare. But to give you an idea, if you look at since inception, I think that we are up at 130. So I'm pretty sure that I would have beat XEQT, which is actually not the number one reason why I invest on my side. So my benchmark, what I use is a half VFV. So to reflect the fact that I'm 50% in US stocks, but since I'm Canadian, I want to also reflect the currency, and the other half in XIU, so tracking the S&P 60. And right now, this year, I kind of had a bad year. I'm like up like 8-9%, which is bad compared to the rest of the market, but I don't have any gold. So, and of course, I don't have like most of the Magnificent Seven do not pay a dividend like Nvidia, or Alphabet is like very just started to pay one last year, so I don't have like necessarily a huge exposure to that. And the benchmark is about face-to-face with my returns right now. And for many years before that, I was actually ahead of my benchmark. But even then, even if I would be 1% behind, what I love is to have that control. And let's be honest, 14% annualized growth rate for the past 8 years. Pretty happy with that. I don't have to complain. I don't necessarily need to average 15 or 17 to reach my goal. And from my financial planner background, I actually planned for my retirement plan at like 6.5. So I'm way ahead of that. That's just what I need on my side.
And I think this is the reality, Mike. Everyone will typically in their investment journey have stretches where there's a year, 2 years, 3 years where we can underperform the market, but we still have a long-term, very sound portfolio, right? Now, you talked about the Magnificent Seven. That was my next question. With the dividend growth investing approach, we will not have the opportunity to invest in companies like Nvidia, like Google. And we hear things every day about how incredible these companies are. How do you navigate FOMO and stick to your plan?
And you're right. There is a lot of noise and a lot of great stories of like, oh, I bought Tesla and now I can buy a condo or whatever. You know, it's like I got rich by this like single trade. But I see investing more like a journey. When I look at my portfolio, I'm not thinking about this year in particular. I'm thinking about the next 40 years. And even the day that I will turn 75, I will still think in the next 40 years, because I'm going to think about the next generation. I'm going to think about my children and grandchildren, not necessarily what's going to happen with my portfolio and my chance of dying in the next 10, 15 years. Of course, at one point it's going to be, I'm going to get there, but I'm still going to manage that portfolio for a very long run. And again, to just go back to one comment I want to have to add to XEQT though, because I run also a membership about retirement planning, so helping people to build their own retirement. And that question came a lot, where you have a lot of independent investors there, but they come up with that questions like, okay, so as I age, my spouse has no interest in managing my the portfolio. So what's going to happen with my stocks at the point where I either don't have the interest of managing my portfolio anymore, or I cannot manage it anymore. And that got me thinking, because I'm in this situation. I'm a younger age, but my wife has absolutely no interest into finance. So I cannot do that. And I started to do research, and my plan B for that is actually to go XEQT and chill, because it's one single line in your portfolio. You have access to almost 9,000 holdings, so you cannot be more diversified than this. It's professionally managed. It's rebalancing automatically, so you don't have to do anything. You just like buy this. You don't even have to look at the stock market anymore, and you withdraw whatever you need to do, and that's it. And this is exactly what I will tell my wife to do the moment that I will not be able to manage. And this is the solution that I find is the perfect one. If you don't want to control anything on your portfolio, that's a really good win.
Well, Mike, why don't we just take a second then to talk about, it's the retirement loop, right? Which is what you've started. What does that service offer?
So the idea of having retirement loops started from my members at Dividend Stocks Rock. They knew that I used to be a financial planner for 10 years. And I started to get requests to do financial projections, because once you start to manage your portfolio, and that could be with stocks, but it could be with ETFs, it's mostly because you want to have a full control over your personal finance. You don't necessarily trust financial advisors, or you have bad experience with them. And unfortunately, I mean, the way the industry works, you have great financial advisors that are really worth the price you pay for, but many of them are just driven by commission, which, I mean, you're going to get an okay service, but you're not necessarily going to get the full thing. So those members started to ask me, well, would you do financial projections? And I'm like, oh, that's interesting. So I started doing a few financial projections for them to see if there was a market. And then I realized that most of my members were actually interested in building their own plan. So this is how I got the idea to build a community of people that are either planning their retirement or young retirees, and not young by age, but just retired. So it's really for people that are maybe like 5 to 10 years before retirement up to 5 to 10 years into retirement. That will help them build their plan. So we have like an Excel spreadsheet that has been designed by a software engineer, and I've tested it with other professional financial planning software. It gets like the right results and so on. And what is great about having your own Excel spreadsheet is you have all your information on your computer, so no one can hack the cloud and get your personal information. You can run as many scenarios as you wish, so you can try different things, different timing into withdrawing like money from your RSPs and so on. And the next part is you can retire each year. And this is what we support members to do, is every year you run your plan again. So you can adapt, and it's very flexible. You can increase your expenses. You can have like one-time events in the spreadsheet. So we're helping them this way. We support them as well with what we call the Looper Show. It's kind of like a monthly webinar. We host it with professionals. We just had one at the beginning of December where we had a financial expert, a financial planner that is expert in expats. So explaining how people, I mean, especially right now, I mean, we get a very nasty winter and it's not even winter yet. So a lot of retirees are just thinking, yeah, maybe I'm going to leave Canada altogether or partially, right? Just to get away from the winter. So we got those kind of expert explaining like, what's the next step, how to do this, like the mistakes to avoid. So it's really everything that is related to retirement. We talk about health, we talk about traveling, of course. A lot of our members are big travelers, so it's also a big topic there. So it's really a support where, you know, sometimes it feels even better to discuss this online with people you don't know that much, instead of like having like a discussion with your friends and family saying, yeah, I have a $1.5 million in my RSP and I don't know what to do with that. This is not usually a conversation we have with a lot of people around us. So now you have a place where everyone is at the same stage, more or less, and you can also benefit from the experience of people that converted their RSP into a RIF and what happened there. So that is also this big community part where you can observe and learn from others.
Mike, I've attended some of your webinars in the past, and it's incredible how many questions you get. And I'm always impressed by your stamina, because by the end of it, there's so much information to cover. And one other question I wanted to ask you was about yield. A lot of us do like yield, but sometimes we can fall into a bit of a yield trap. The dividend yield is very high, or it continues to creep up. Sometimes that can mean a company that may be in decline, or maybe the dividend is not sustainable. And recently we saw a few examples. Northland Power slashed their dividend quite significantly. And then I believe TELUS also made an announcement that they will not be hiking their dividend. So just a couple of examples here. Now, can you give us some tips on how to navigate this and how to avoid yield traps?
Yeah, so first, we're going to start with the basis. There's no free lunch in finance. So if you find something that pays you a great yield, there's a reason for that, because the market is not stupid, right? It's not true that you're the only one investor that find out this like 8% yielder, or we have like now products offering you like 15, 20, 50% yield. It is not true that you're the only one thinking that you're going to make money out of that and there's absolutely no risk and it's completely sustainable. So when you have a company offering a higher yield, it's mostly because the company is not growing fast enough and therefore investors are not buying. There's no demand for the stock, so the stock price either decline or the dividend does not increase anymore and get stock very high. So you need to understand why this is happening. Most cases, you're going to have mature businesses. So It is a red flag to have a yield above 5%, but it's not automatically a sell. Some great companies will continue to have a high yield for several years, and they're going to be fine. Like, I can think of like Enbridge, for example, that is a pretty good example. They are able to increase their dividend 3% a year, so it's not that much, but it matches inflation most of the time. And they have this stable business. It's never going to propel your portfolio like an Nvidia or a Tesla, but it's going to do its job. So if you want, but of course the line is really thin between a yield trap and what I call the deluxe bond. So a company that you're not going to get much out of the stock appreciation, but the yield will be good and the dividend will continue to increase, because of course those companies are mature. They probably have less growth vectors. So we can think of like TELUS and Bell were like great example for that. Bell and TELUS for decades have been great investment. And then as interest rate started to increase back in 21, 22, now they had interest charges a little bit too big. They are capital intensive. It requires like billions of dollars to run their business and maintain their network. So they're kind of stuck where the growth is limited, because I mean, once you have your cell phone and your internet and your cable bills, you're not going to have like 3 cable bills or 5 phones. I mean, it's like one iPhone and there you go, you're done. So growth is limited. The capital required to run the business is really high. So there is a really thin line here, and this is how you must first monitor those businesses quarterly. And a few things that I like to do is to ensure that there's a minimum of revenue growth, a minimum of earnings growth, and of course, the dividend. So going back to Northland Power was quite popular about the narrative. So the investment thesis around renewable energy, investors were like super excited back in 2020, 2021. All the stocks that were related to renewable energy back then, they got a lot of press, a lot of media covering them, and it was the next big thing. The problem with Northland Power was it does not generate enough earnings to pay their dividends. So their payout ratio was always super high. The yield was high, so you already have like 2 red flags. And the third one is it was not increasing its dividend. Like, it's been like decade, like not even maybe a decade of no dividend increases while the market was great. So when you have a great economy and the interest rates are low and the employment rates is low and consumer is spending and you're not able to increase your dividend, what do you think is going to happen when things are a little bit rougher right now? Now we have the impact of like 5 years of inflation. Interest rates are slightly higher than before. The consumers are tighter with their budget. Well, of course, we don't need even to get into a recession. It's just less interesting in terms of economic environment than it was 5 years ago. Well, then those companies were already at the limit of what they could do in a thriving economy. So if there's just a small slowdown, they have no other choices but to cut the dividend. So what I do is, for all the stocks that I have, if you have a high yield, that's one red flag. Then you need to look at the dividend triangle perspective. So what's happening with the revenue, the earnings, and the dividend? If you have struggling revenues, shaky earnings, going up, going down, having problem with margins, you have a no dividend increases, and then you look at the payout ratios, and then you discover they're like 90%, 100%, 110%. Well, then you're kind of like ticking all the boxes of, well, the next step for that business is to cut their dividend. And again, keep in mind, from the business point of view, the dividend is a debt. So if I have, just go back to a personal level, if I give a very generous allocation to my children and I lose my job, well, probably the first thing I'm going to do is I'm going to cut that allocation because it's not useful. I'm going to feel bad about it, but I'm going to cut the allocation before not going to the grocery store. I'm going to keep the house running first. So the business is going to do the same thing. Management will focus on keeping their job and then keeping the business safe. And then they're going to think about the shareholders. So never forget about that. Again, no free lunch in finance.
For payout ratios, Mike, is there an upper limit that you become uncomfortable with, or is it more the trend that you keep an eye on?
You have to put the payout ratio into a context first, because first there are different types of payout ratios. You can calculate the payout ratio based on earnings, which is the classic way. You can do it based on free cash flow, the cash flow payout ratio, which is a purest way to calculate it. But the problem with that is if you have a major project and you get into 2 billions of debt, well, your free cash flow is going to be destroyed because you're leveraging the business for the project. But at the same time, you could also say, well, you cannot afford to invest in that project and pay the dividend, so you're borrowing money to invest into to reward shareholders. So that's the cash payout ratio. And then for REITs and for some utilities, you're going to use the FFO, the funds from operation payout ratio. So there are different types of calculation, which is important to understand first. And then it's important to put a context. So of course, anything that is above 100%, well, of course you're gonna raise your eyebrows. You're just like, yeah, well, that's again one red flag. It's not the ultimate red flag, but if you combine this with a high yield and no increase and a struggling dividend triangle, now you have a problem. Okay. But maybe you're going to have a high payout ratio. I mean, TD, for example, last year, they got caught with the anti-money laundering problems, and they had to register a major one-time event charge in their in their financial statements. So that drove the payout ratio probably above 100% for that quarter. But that was a one-time charge. So yes, it's bad. I mean, it's not good. But you know that in 26, in 27, 28, that charge is not going to happen again. So they will continue to pay their dividend and actually increase it. So it's really important to not just look at, and I've seen a lot of investors just doing like stock screener and say, I don't invest in anything with a payout ratio above 80%. Not a bad way of seeing it, but you will discard some great companies from time to time. One of my favorite company, for example, Broadcom, is growing through major acquisitions all the time. It's not just an AI company. They were doing well way before the AI hype. But the thing is, with a lot of acquisitions, from time to time, the earnings were really low compared to their dividend. So just because you have amortization, you have acquisition charges, and all of those accounting charges that are not necessarily linked to cash flow. So the company kept on increasing their dividend very generously, but the payout ratio from time to time is above 100%, which doesn't mean anything in this situation. But again, it comes down to, yes, there's a red flag. So I always call that as an invitation for investigation. So you see something that is wrong, good reflex. Now find the reason why.
Great examples, Mike. Thank you. Last question on yield. We've seen a lot of covered call ETFs come onto the scene. So they'll talk about an enhanced yield or enhanced income. What is your thought on these products as to where they can fit into our portfolios?
I'm gonna be very clear on that. I hate them. I don't think they're good products at all. The thing is, by definition, you have like two types of covered call ETFs. Okay, so you have the classic one that are not new. They were created like around 2011, 2012. So like it's not something. Oh, I just discovered that. I'm like, well, you're more than a decade late. The first one I actually tried it in 2012. I bought some ZWB, which is a covered call by BMO, writing covered calls on the 6 big banks. Super easy to understand. You have like 6 banks, you're writing covered calls on them. There you go. But then you have to understand that there's a price to pay to get the income. And that price is you limit your upside potential. Because when you write, like, let's just for your audience, if you have a stock that trades at $100, you write a call. So you give the option, I'm giving you the option, Yatin, to buy my stock at $110, okay? So you're gonna pay me, let's say, $1 for that. So I'm getting that as an addition to the yield, and I still hold the shares, getting the dividends, so I'm just adding some income. The stock price goes to $125, I am forced to sell it to you at $110. So I'm not getting the full upside. So that's one. But when the market goes down, imagine that. So I have that shares of like $100. It goes to $75. Now I'm writing a covered call on it to you again. But then you're going to say, well, Mike, your stock is going down all the time. I'm not willing to pay that much of a premium to have the right to buy it back at $85, right? So yes, you're going to pay a premium, but it's going to be smaller because it's less interesting. Then when the stock goes back to 100, I don't recover. I sold it at $85 to you and you get the upside. So I'm not during a recovery. And most of the time when you look at the stock market, when there's a recovery, it goes up very quickly. So my odds are I'm not going to be able to capture all the gains. And the whole investment games is based on the fact that you're buying assets to make profit. So you're limiting your upside in exchange to get income, where you could have just sold some shares. And it's the exact thing. What I did that for fun for like 12 years. Every quarter, I would make the difference of, okay, I have ZWB versus ZEB, so which is exactly the same BMO ETF, but one is 6 banks, the other one is 6 banks and writing cover calls. And every first day of the quarter, I just sell the equivalent of shares to just match the distribution of the other. And after 10 years, I got $300,000 difference. Of course, if I had the one that is not the covered call with the exact same source of income. So you're paying for conveniency. So instead of you selling, and you don't have to time the market, you can really just say, hey, the first Monday of every quarter or every month, I'm just going to sell some shares, and boom, you're done. It's the total return that will generate your income. That's just pure math. If you are not up 10% in total return and you give away more than 10% in yield, well, your value goes down. There's no other way. You cannot create magic. So those are not that bad, because you're going to get the income. You're going to feel good about it. They're just a price to pay because you leave money on the table. The second generation, the new one that happened to work, they were created like 2-3 years ago, not more than that. They're leveraged covered call ETFs. So they're using leverage on top of writing covered calls, and now they have been famous because a lot of them focus on popular stocks such as Nvidia or MSTR and Apple and Google and so on. And well, the market has been going up double digit for the past 3 years. So it's only normal that they are able to deliver on that promise for most of them, simply because the assets that they have are just doing incredibly well. But whatever happens when we have a bear market and the market goes down by 20%, well, your distribution is going to get cut. And we just had the perfect example with MSTE, which is a covered call on MicroStrategy, which is just a business that using leverage to make a play on Bitcoin. Like, long story short, that's pretty much it. Well, for the past 6 months, Bitcoin is pretty stable, down maybe like 5-10%, so not growing. And this company is offering a super high distribution yield. So whatever they do is, well, you see that the MSTE price is going down, down, and down, and down. The distribution is getting cut and cut and cut. And the only way up is if Bitcoin goes back up. And again, going back to the beginning of my explanation, if Bitcoin goes from like $90,000 right now to 150, you're not going to capture the full upside, especially if it goes fast. You're going to get a part of it, which is great, but not the full one. So if you want to make a play on Bitcoin, just buy Bitcoin. And then you can sell some of it, and you're going to generate more income by selling like this, instead of paying fees and letting the investment firm do all the work for you and decide how much you're going to generate in income. And finally, you could ask yourself why no pension plan, no government, no institutional investors are buying those products. Because, I mean, when you think about that,
that's
you
true.
have a
That's
debt.
a good point.
You have a debt, and then let's say you have like $1 million in debt. Well, you could buy $1 million of a leveraged covered call ETF paying 25% yield, pay off your debt in 4 years, and then earn $250,000 a year forever. I mean, think about that for a second. It seems like it's the best deal ever, right? And if you want to make 25% total return per year, you're pretty close to being Warren Buffett. So I don't know about you, but I know I'm not able to do this. If the covered call ETF of this world can say we're going to match Warren Buffett's and actually beat Warren Buffett returns over the next 25 years, I'm just waiting here to be wrong on that, but I'll be surprised.
Mike, I would love to ask you, you started the episode talking about the dividend triangle and your approach. Have you ever gone beneath the hood to see, in your outperformers, the stocks that did the best, was there ever anything else at play, like a higher return on invested capital or a more rapid escalation of free cash flow? I'm curious if you ever came across any of this in your analysis.
Well, the thing is, once you start with, when you have a robust dividend triangle, you're investing in a thriving business. So then going forward, the key is just to ensure that the company continues on this path. Because of course, You can find, I mean, I bought TELUS like more than 10 years ago. It had a great dividend triangle back then, but things changes. I mean, it sucks. We wish we could just hold shares of stocks forever, like the buy and hold. I love that. And a lot of my big winners have been compounding this for several years. But one thing that I've noticed is, and this is where I completely became yield agnostic, is most of my best performing stocks have low dividend yield and a high dividend growth. So I always talk about low yield, high growth stocks. So companies that will offer, like Visa would be a perfect example, or Dollarama. They have like super low yield, but they grow their dividend by like 10% per year forever. And they still have super low payout ratio. So a lot of people will say, but Mike, how can I live on like a 0.50% or 0.40% yield? And you're not. You're not going to do that, but you're going to live on your total return. And that's the combination of your capital appreciation plus your yield. Because again, if I have, and sometimes people like, they're doing that quick math of, I get 5% yield, it's great. But that 5% is just money getting outside of the corporate bank account into your bank account. So the company's value is lower. If tomorrow morning, Microsoft decides to pay $500 billion in dividend, do you really think that the value is not going to change the day that they paid that? Well, of course it will. The money is gone. So it's like selling your house and say, okay, yeah, then you can buy my house for $500,000, but inside my house, I have for $200,000 worth of gold. And the day that you go into my house and you are finally the owner, super happy to open that lock and say, oh, I have like this $200,000 worth of gold. If it's not there, I'm pretty sure you're going to come back at me and say, hey, Mike, I paid $500 knowing there was like $200,000 there. Now it's not there. I want my money back. It's only worth $300. It's not true. The money is gone, well, the value goes down. So you have to be careful about that once again, and you can create your own income with a mix of shares and dividend instead.
I love your comment on low yield, high dividend growth and focusing on total return because, Mike, I think to me that captures the essence of dividend growth investing. But I want to move on to valuation. And this is an area where I'm still learning, and maybe we may differ a little bit here. And I'm glad you mentioned Dollarama because that's my example for this section. So I grew up in a household. My family's from India. We came to Canada in 1985. I was always taught to look for bargains, look for deals. And perhaps that's translated over to my investment strategy. So this was maybe a couple years ago when Dollarama's price had dipped. I had very little cash and I bought just a little bit of Dollarama when its share price was around $90. I felt okay then because I think the price to earnings ratio was maybe around 29-30, more historical norms, just slightly below. That is when I tend to make more of my purchases, when the price to earnings ratio or whatever valuation metric I'm using is below historical norms. Also, I read a fascinating little book, The Little Book That Beats the Market by Joel Greenblatt. And in his magic formula that he describes, half of that formula is based on stocks that are fairly valued or cheaply valued. But then when I look at Dollarama, today the company is thriving on all cylinders. Its price to earnings ratio is probably in the mid 40s. If you use a forward, maybe it's in the mid 30s, higher than average. But because I was so fixated on valuation, I missed out on an opportunity to invest more into a great company. So, Mike, I would love for you to comment on valuation and where does this fit into your strategy and perhaps when you make your purchases, if it impacts that at all.
I give little weight in my investment decision to valuation, mostly because it's impossible to know what's going to hold the future. I mean, of course, we all want to buy a stock at a low price earning ratio or any valuation method that you do because it's a good deal and then it's going to be better going forward. The problem here is all the information is available for everyone. So you may come up with a super complex and fancy calculation to determine that Dollarama stock price should be $100.42. Well, I'm going to argue why not $100.75 or why not $99 or $105, and your guess will be as good as mine because all those calculations are based on assumptions. And each assumption is projected in the future is going to be super hard to determine. So when it comes down to valuation, I do two things. I look at the P ratio versus its average, as you mentioned. So because now it's going to tell me what the market usually pays for this company. Because a 30 P ratio or a 35 or a 22 doesn't mean anything. For the story, if you, I'm going to offer you a great investment proposition right now. I have a company that has absolutely no debt, $4 billion in cash, trades at a P ratio of 4. Would you be and dominating their market? Would you be interested? Like, sounds appealing, right?
I'd be very, very interested. Yeah.
Well, that company was BlackBerry right before Apple goes with its iPhone and completely destroyed the business. It was in the process of completely destroying it. Yet was trading a super low P ratio, no debt, everything was perfect. So the P ratio or any valuation metrics could be interesting or not. So I look at the average just to give a sense of like, okay, so is it trading above or under the average? Maybe there's something here that is interesting, but maybe not once again, because I don't pretend to know more than the rest of all investors. I do the same thing for the yield, because again, it's similar. Most of the companies will roughly pay about the same yield most of the time. If it's a higher yield, well, maybe there's an opportunity there. There's definitely a reason, so you need to understand the reason first and see if you're willing to take that risk. But overall, once I've completed my analysis that started with the dividend triangle, the second step is really to write down my investment thesis. So really understand the business model and how it's going to continue to grow, looking at the risk. Most of the time, if I have money at that time, I'm just going to buy. And to complete the story, in 2017, when I received my pension plan, it was at the market. The market was trading at all-time high. It was like, if you look at, you just have to Google like stock market 2017, greatly overvalued, whatever. You're gonna find a bunch of articles saying 30, 40% overvalued. I bought Microsoft back then, $75. Greatly overpriced. And if you look at the articles back then on Seeking Alpha, Fast Graph, Financial Analyst, everyone were saying, $75, man, you're crazy, way too much. Wait until it's like 55, 60. That's the right price to buy Microsoft. Well, two things happen. You're smiling, so you already know where Microsoft is trading at right now. I'm up, I think, like 600 or 700%. I can't remember, but I mean, anyways, it's highly up. And the second thing is, it never dropped to $55. So if today, you would be still waiting to get it at $55, which, unless they split, it's never going to happen, and then you're not going to get the deal. So long story short, because I cannot know, and you know, I do this exercise every year. I just have so much fun. With Dividend Stocks Rock, information data is powered by Warchart and Refinitiv. And Refinitiv is owned by the London Stock Exchange. It used to be owned by Thomson Reuters, a Canadian company. So very, like, a lot of data there, like very professional. It costs like more than $20,000 to have access to that kind of information, right? And one thing they do is they give you the price target according to each professional analyst. You know, those guys are paying millions of dollars. They can call the CEO whenever they want. They have like a team of research. They have all the resources in the world, a lot more than anyone else, and they issue price targets. And on popular stocks, you may have like sometimes 30, 40, 50 analysts of different firms. They all have a different price target. The most optimistic will be up maybe 30%, and the most pessimistic will be down 30%. So your range for a stock is like that trades at $100 is either, oh, it's going to be worth $130 or $75. Well, where do you go from there? They have all the information that they're not even able to give you a value for the next 12 months. And you think that in your office, reading some blogs or like doing some YouTube research or whatever, you're gonna like pull out a better valuation than those guys? I don't think so either. So I prefer to invest with a high level of conviction. And then once the metrics are good and the investment thesis is clear, I just invest. And most of the time, actually, my best performing stocks, most of them were bought at a 52 weeks high.
Interesting.
So for me, it's not a metric in the end.
Okay, interesting. Let's use that example of Microsoft running up 600 to 700% to segue to the next question, which is, when do you sell, trim, rebalance in your portfolio?
So if a company, and I don't make any investment decisions based on price returns.
Yep.
So the company could go up, could go down. It does not influence my perception of the business, because too many investors, especially short term, they look at a stock. Oh, it's down 25%. It's a crappy business. Oh, it's up 25%. It's an amazing business. That doesn't tell you anything. So what I do in terms of like buying and selling decisions is really based on, is my investment thesis still relevant? And is it backed by numbers? So sometimes you can tell yourself a great story about a stock, but the numbers are not there. I like to take this example of say, oh, Yatin, if I tell you that I'm training with an Olympic trainer and I follow a super high diet and in my families we're all like Ironman runners and stuff like that, and you look at me and I'm like overweight at like 300 pounds, you're not going to believe me, right? Like a great story, but if I tell you I'm an athlete, you're going to say, well, I don't think, Mike, I think it's not working for you well, the story. So you need the metrics. But then when I have a winner that goes on and on and on, I let it run. I let it run until I hit what I call my exposure to risk. So the exposure to risk to a single stock. So if everything is great, but the stock, it's more than 10% of all my investment, this is where I don't feel comfortable. And the 10% is, it could be 6 for you. The point is to make up that decision is more like, imagine you have $1 million invested. When do you feel bad about your portfolio? So imagine 50% loss in investment. So if you have one stock, would you be comfortable losing $500,000? Answer is probably no, right? It's probably way too much. So now you go down and say, okay, so what about you have $100,000 invested in there, so you could lose 50%, so $50,000 out of that. This is where I draw my line. Your line could be $30,000, and therefore you say, oh, anytime that a stock goes up to 6%, I don't want to lose 3% of all my investment, so I'm going to trim. So my limit is at 10. I trimmed several times in the past. Apple, 4 times already, Microsoft once. And when it goes to 10, what I do is I sell for about 2%. So it's really just trimming. So it's still at 8, still a very strong position. So if it continues to do well, like Apple, I mean, great, it drives my portfolio, I'm super happy. And whenever it goes above that, I just want to be secure. I want to protect myself, my portfolio from myself, not falling in love with a stock. So I end up with having a few companies that are 5, 6, 7, 8% of my portfolio. And from time to time, I trim. And that's how I keep it very simple.
Okay. Mike, how do you go about reinvesting dividends? Do you use a drip where it automatically goes into the same shares? Or do you take the dividends and do you invest them more selectively?
I see both strategies as good. Personally, I prefer to let the dividend being deposited in the account because I prefer to rebalance my portfolio using that money. But I mean, the good point about dripping is you already buy stocks of companies that you like already. So you're on autopilot, you don't have to do anything. And it's a great way. I mean, it goes there. The downside is sometimes you can grow a position way too much because you're just buying too much of the same stock.
Yeah.
On the other side, when you use the dividend, the biggest advantage is to be able to rebalance so you have control. The disadvantage is, well, if you are not hands-on your portfolio, you can grow to a few $1,000s that are sleeping there and not being invested. So it's just a matter of like which kind of investor you are, but both strategies are work very well.
Okay, perfect. And a shout out to my friend Dimitri Rana for that question. He's a very astute investor. Quickly, your best and worst investments.
Okay, so I'm gonna have like 2 worst. One a very long time ago and one not too far. So worst investment ever was when I sold my first house. I have my cash down ready to buy the second one, and there was like a time between. I was in my 20s. I thought, hey, you know what? I'm gonna hit a home run in the meantime, and not only buy a new house, but buy a BMW cash, right? So I use a part of my cash down to buy into a small penny stock mining company because, you know, I was working with a friend, and that friend, his father, was friend with somebody else that was working for that company. Of course, going to bring great reports. So long story short, I came back from lunch one day, refreshed my brokerage account, and I'm down 50%. And I'm like, it's not possible that a penny stock split, because I was really down 50% flush. I'm like, but there's no possibility that it goes from $1 to 50 cents, right? It's not making sense. And of course, they were like issuing bad results, lost half of the part of that cash down. So a humbling experience to not gamble with my money. And that also let me think, now I need to get a better structure. Not too long ago in 2020, I think, I had Algonquin in my portfolio. I was seduced by the narrative, growth by acquisition, greening process, increasing the dividend, 5-6% per year. Everything was running fine. And the mistake I made is I put too much emphasis on the thesis, so on the narrative, the story, not enough on the numbers. So I got burnt. I sold on the dividend cut and moved on. The advantage of being diversified, it did not kill my portfolio. I mean, yes, I lost money, but when you have like a 3% position in something, it goes down to like 2%. I mean, it sucks, but it's just 1% that you lose, you move on, and there you go. What I've learned from that though is to focus a lot more on the numbers. So now I always put the numbers first, and then I look at the story, never the other way around, which is not always too easy to do. In terms of best investment, again, a while ago in 2014, I bought Apple when it first started to pay a dividend. So you were talking about at the beginning of this interview of, well, missing out on FOMO on great companies that are not paying dividend. Well, you can still make a lot of money with companies that just starts to pay a dividend anyway. I bought Apple back then based on the fact that they were showing a great dividend triangle, even though we had like 1 or 2 years of dividend history back then. The rest of the story was like, well, of course they're going to continue to increase their dividend. They have a great business model, a lot of cash flow. Turned out to be, I'm up 1900% on this one.
Wow,
and I thought those stories, but I thought those stories were not possible back then. You know, when you start investing, you're just like, oh yeah, but those guys were just lucky of showing like 500% return on a stock or 1000%. But the key is really just to let your winners run. I have like plenty of stocks that are triple digit returns in my portfolio just because of that. So just making the right investment decision and sticking to it and not resisting the urge of like, oh, I'm gonna play with house money and sell like half of my portfolio, like half of my position once I'm up 100%. I just let those run and they compound together. And yeah, so I mean, Microsoft was another pretty good one. Big fan of National Bank. I've been buying more and more for several years.
I know you love National, yeah.
I have to talk about it, right? And yeah, so most recently, companies that, of course, not financial advice, but it's always fun to have like companies that are doing well, but I think they're going to do better. Over the past 2 years, I bought some Stentech. It's an engineering firm, stn.to. What I like about this one is there is this mega trend that we're not talking too much about investment in infrastructure. Now it's become more public because you don't only have like bridges and roads and stuff like that and buildings, but data centers to drive to support AI. But what they do at Stentech is they support their clients from A to Z. So from the planning, the building, the maintaining, and also the decommissioning of any kind of infrastructure. They can cross-sell with various services. They grow by acquisition. And they show a perfect dividend triangle. So I really like this one. I bought it about 1.5 years ago. It's doing well, but I know that it's going to continue to do well. I believe it's going to continue to do well. So I suggest you do your due diligence on this one for sure. But very happy about it. I mean, Dollarama, I started 25 with the intention of starting a position on this one. I kick myself for not believing in the company. That's a good example of a business where it shows perfect metrics for the past 10 years, according to my dividend triangle. But for several years, I did not believe in the thesis. I thought, well, one day, Dollarama will not be able to grow within Canada just by opening new stores. I mean, there's a limit of stores that the population can hold.
I shared those concerns with you, Mike, because I see Dollaramas everywhere. So
yeah. But the thing is, and this is what I've like after more digging, one thing is they have this kind of plan for the past like 15 years. They come with their guidance of how many stores they will open, and they have their playbook where within 2 years those stores become profitable. They're always on target or in advance, and now they made acquisitions on top of that. So they're using the same playbook with the stake they own in Dollar City. They now own 60% of that. Similar dollar store, but in Central America, and now they have started to open new stores in Mexico. So great market to grow there. And more recently, they acquired the Reject Shops, which is 400 stores in Australia. And they tend to do exactly the same playbook. So because the management team has been in place for years, they have this expertise, and they have proven that they can run this playbook over and over. This is why I decided to, I know I'm late, but I think that there's a lot more potential moving forward. And I like also the fact that it's not only a growing business, but also a defensive one, because if we get into a recession tomorrow morning, actually, it's going to drive more people there. It's already happening with inflation. So it's kind of like an interesting play where you play offense and defense at the same time. So you rarely have that in your portfolio. So,
Mike, this conversation brings me to my last question, which also my friend and listener Dimitri had contributed to. But you had mentioned a few names here that you find interesting today: Stantec, Dollarama. Everybody, of course, please do your due diligence. But any other names that you find interesting in general in the dividend growth space or related to the AI infrastructure spend?
yeah, that is a very interesting question. What I've discussed with my members this year at several times is, instead of going full FOMO and buy all the semiconductors, find companies that were doing well before the AI hype. Because it's one thing to have this tailwind, which I think is going to continue for a while though. I did a lot of research, and what I see here is, yes, you may be thinking that some of those guys are overpriced at 30, 35 times the earnings. But if you compare to the valuation of Microsoft and Cisco back in 2000, right before the tech bubble, Cisco was trading like at 200 times its earning. So we're not there. We're not there yet. If NVIDIA was trading at 200 times, I would be a bit scared. Right now, yes, it's not a bargain, definitely not, but there's still room to grow. So I have mixed feelings about the AI bubble at this point, but companies that I like that are linked to this are companies like Broadcom, because they grow by acquisition. They have a solid base of cash flow coming from the RF filters they're making. And RF filters, in less technical term, they are improving connection with smartphones. I think we're going to use our smartphones for a few years still. So I think the connection will be important. So that's good. And what they benefit from AI is they are building highways for calculations. That's pretty much how you can picture that. So their chips are made to become calculation, taking less energy, becoming more efficient and faster. In any kind of world, we want to have faster computer calculation at a less amount of energy, because that has become also another big investment themes about the need for power to drive all of this new technology. So they are in a very interesting place for AI, but they were doing good before that. Similar to, again, Microsoft, to come back to them, but I mean, they're everywhere. They have like a lot of cash flow coming from their subscription base with all the software they offer. They're number two beyond AOIS and their cloud services with Azure. That was way before AI as well. And now they're playing with AI. So it's great to have companies like this. ASML, if you want to be a little bit more on the chip making side, because they're building the equipment that will, like the super high tech equipment that will serve semiconductors builders. So you have Lam Research and then KLAC as well that are making different parts of equipment. So I kind of like the one that are providing those equipments instead of making pure plays on semiconductors. Those are companies that I think they're going to do well. And what is interesting now is you have AI used to be around tech stocks for obvious reasons, but now it became at the macro level, because you have all those construction being made. So now you have plays to be made in utilities for power. You have plays to, like Stantec is another reason why I like it, is they're going to be also involved in building data centers. Toromont Industries and Finning International, those stocks have done very well. They've been highlighted at DSR a while ago as well for the same reason. But those companies were doing great before. I mean, Toromont, I think they show like 30 years of dividend increases. So they have not started to become a great business yesterday. So I think that's the most important part here.
Okay, Mike, as we bring it home, is there anything else you'd like to share about DSR, dividend stocks, ROC, that maybe you didn't talk about yet? And in general, where can people find you and learn more about what you're doing?
Sure, thanks. So if you are interested in managing your portfolio with a focus on dividend growth stocks, we cover over 1,000 companies, Canadian and US, and we have all the tools that you need to manage your portfolio. If you want to know more about my strategy, you can download the Dividend Income for Life guide that is 100% free. You just have to go to dividendstocksrock.com/income, and you're going to be able to download the guide. You'll see my strategy, why I believe in low yield, high growth stocks versus high yielding companies, and how you can actually create income using a clear strategy, not being forced by the market to sell at a bad time as well. Not that complicated either, and this is what I intend to do once I retire. If not, well, search for The Dividend Guy. I'm on YouTube, I have a podcast. If you love podcasts like this one, you're gonna like the Moose on the Loose. It's 10 minutes every working day where I talk about Canadian investing, so just a lot of fun there. So, thank you so much for having me. It has been such a pleasure.
It has been so much fun, Mike, and I have to say, for me, a full circle moment since the time I started following you. So an honor to have you on the show, and thank you for making the time.
It's been amazing.
Okay, man, take care.
You too.